Is the entire market completely broken? In this video, I'm going to explain why fantastic earnings reports from giants like Johnson & Johnson are being completely ignored and where you can find potential opportunities in this chaotic environment. The S&P 500 is falling hard, erasing all of yesterday's gains. This isn't random. It's because China just escalated its trade war with the US, and I'll show you exactly how that impacts your portfolio. The big story today is geopolitics. China has imposed sanctions on several U.S. subsidiaries of Hanwha Ocean, a massive South Korean shipping company. This move is sending shockwaves through the market because it directly targets global trade flows. The market hates uncertainty, and this is a huge dose of it. We're seeing the fallout everywhere. The S&P 500 is down, tech is taking a beating, AI darlings like Nvidia and AMD lost over 2%. Tesla is down almost 3%. Even ORCL and Chinese stocks like Alibaba are deep in the red. The market is pricing in risk, and it's happening fast. But here's the paradox. While the market is panicking about China, some of the biggest U.S. companies are reporting fantastic results. JP Morgan and Johnson & Johnson just beat expectations on their quarterly earnings. Johnson & Johnson even raised their full-year forecast and announced plans to separate their slower-growing orthopedics business. This is a smart, strategic move to unlock value. So why is no one celebrating? Because fear is a much stronger emotion than greed right now. The threat of an escalating trade war is overshadowing everything else. If you're getting value from this kind of direct, no-nonsense analysis, make sure you subscribe to the channel. It's the best way to stay ahead in a market that changes this quickly. Now let's talk about specific opportunities and risks. All eyes are on ASML, the semiconductor equipment giant. Their earnings are coming up, and expectations are sky-high after a massive run-up in its stock price. Investors want proof that the AI boom will keep driving massive chip orders. But I'm cautious here. With the U.S. restricting chip technology to China and China retaliating, ASML is caught in the middle. The risk is that they can't provide the strong future guidance the market is demanding. The stock has already priced in perfection, and in this environment, perfection is hard to come by. This leads me to a crucial point for today's market. It's better to lower your expectations for annual returns and get a lower yield with a higher probability of success rather than chasing high returns with a low chance of actually getting them. And that's why I'm looking at a company like Kenvue. You know them, they're the consumer health company spun off from Johnson & Johnson. Given the heated market and the interference from China, an entry into Kenvue might be much preferable to an entry into ASML right now. ASML could give you a 20% return, or it could give you a minus 20% return. The range is wide. Kenvue's potential return is smaller, but the probability of achieving a positive, stable return is much higher. In this market, I prefer stability. You have to be sure about your investments. They are what you will go to bed with at night. Let's switch gears to another company that just reported, Domino's Pizza. They beat earnings expectations, driven by demand for promotions and their stuffed crust pizzas. This is interesting because it shows that even with concerns about consumer spending, a good value proposition still wins. Their margins are improving and they're executing well. I ran a quick calculation, and based on their earnings potential and a reasonable multiple, you could see a path to a higher stock price from here. It's one to watch. We also saw great news from Ericsson. The stock surged after reporting strong third-quarter earnings and cash flow, which was massively boosted by the sale of a business unit. This shows a company strengthening its financial position, which could mean more returns for shareholders down the line. And let's not forget Google. They just announced a plan to invest around $15 billion over the next 5 years to build an AI infrastructure hub in southern India. This is a massive, long-term strategic bet on one of the world's fastest-growing economies. It's a sign of where the smart money is going for the next decade. So what's the takeaway? The market is driven by fear of China right now. My personal opinion is that China doesn't actually want to escalate this conflict further, but once these actions are taken, it's very difficult to backtrack. This uncertainty is creating a disconnect between strong company fundamentals and falling stock prices. In this environment, you have two choices: get scared out of the market, or look for quality companies that are being unfairly punished, or defensive names that offer stability. Choose your investments wisely. So what are your moves? I'm curious to know if you have initiated positions in Kenvue, Domino's Pizza, or even Pepsi, and what factors influenced your decisions. Let me know in the comments below. And if you haven't already, hit that subscribe button to join our community. See you in the next video.